Hello, and welcome to Chapter 20. This is on cost, volume, profit analysis. This is some good stuff. This is entirely internal reporting where you're trying to make decisions about how many do you need to sell or how many do you need to manufacture in order to break even and to hit a targeted profit. When we look at this chapter, and it's giving you a brief overview here. I know you can look at the PowerPoints and read the text, but when we look at this chapter, everything's always the opposite. When we look at this chapter, and here I've got at the bottom, chapter 20, which is what we're in chapter 16, that was our income statement format. Sales minus cost of goods sold. Remember the big three: direct material, direct labor, and overhead. Sales minus cost of goods sold is my gross margin, GM, gross margin. And then we subtract selling, general, and administrative, and we get our net income. That's what most manufacturing or merchandising type companies use for external financial reporting. You know, I talked about financial accounting is about external reporting, and managerial accounting is about internal. But there is part of this managerial accounting that what you're doing there with your cost of goods sold, and you have to follow GAAP. And so it's okay to use a format like this in your external reporting. Now that we get to chapter 20, we've got a new layout for the income statement because both of these are income statements. And so what we're going to look at here in chapter 20 is sales minus your variable costs. That's what VC stands for. Variable cost is my contribution margin. And that's contribution toward whatever your fixed cost or your targeted profit is. And we'll get to that here in just a second. The contribution margin minus fixed cost gives me the same end result, net income. So both these net incomes are going to be the same. It's just how do you slice up what cost or what and what expense. So when we look at sales minus variable cost, this chapter is about cost behavior. Cost behavior. You think, what in the world is cost behavior? It's one of two things. It's either a variable cost or it's a fixed cost. You know, as a good example used to be, it was cell phones. If you bought a cell phone, you would have so many minutes and so many texts in a month for a fixed fee, and anything beyond that, you would have to actually pay per minute. Now, most plans aren't like that anymore, but that's a good example of you have a fixed portion that you pay every month, and then any additional is a variable portion. So that's what fixed and variable is. Another good example is at Exxon, we had an electricity bill every month that before we used 1 kilowatt hour, we had to pay $36,000 for fixed costs. Had to do with the infrastructure, things like transformers, the underground lines, maybe switch gear was a part of that, maybe the substation, if that was built for us. But we had to pay $36,000. Then once you start using electricity, you're paying so much per kilowatt hour. And of course, it went down, the cost per kilowatt hour went down the more you use, and we would use somewhere around 7 million kilowatt hours in a month. So there's another good example. There's a fixed portion and there's a variable portion. Well, that's what you're doing in your business. What are your variable costs, right? And your variable costs from your sales, because your sales revenue is variable. Sales revenue is variable, 100% variable, minus your variable cost, gives you your contribution margin. And you can do this per unit. And when you do it per unit, that tells you how much contribution per unit is going against my fixed cost to see how many units do I have to sell to break even, to cover those fixed costs, all right? So keep that in mind in this chapter. When we start looking at formulas, and all of this is out there in the D2L content, when we start looking at formulas, here are some more I just scratched out here on my legal pad. There's two things in this chapter when we start talking about break even. Break even in units and break even in sales dollars. Now it's really just one, because if you know what the break even in units is, all you have to do is multiply by your sales price per unit, right? Yes. But look at those formulas up here. If we're trying to figure out how many units do I have to sell to break even, meaning I neither have a profit nor a loss, I'd take my fixed cost as the numerator and divide that by what's called the contribution margin per unit. Well, what's the contribution margin per unit? Well, it's your sales revenue minus your variable cost is your contribution margin. Need to put that on there. Sales minus variable cost, and this is per unit. If I'm selling something for $10 and it costs me $4 variable cost, and I got $6 contribution margin per unit. So whatever my fixed costs are divided by that $6 tells me how many units do I have to sell to cover my fixed costs, right? Yes. The second part of this that the book doesn't really make it clear like I think it should is the second formula that, well, what if I have a targeted profit? TP, target profit. Well, target profit is really like adding additional fixed cost. So don't think that this is something that is a different formula. It's not. You're just adding your targeted profit to your fixed cost to divide by contribution margin per unit. All right. Then the bottom part here in red is what I call break even in sales dollars. Well, whatever units you come up with up here, you can multiply by your sales price per unit to get your break even in sales dollars. But if you want to, you can actually use a formula called contribution margin ratio, which in this particular case up here, if your sales were, what did I say, $10 and your variable cost was $4, your contribution margin is $6. Right there. So what is my contribution margin ratio? With 6 divided by 10, right? Contribution margin is $6 divided by $10. 6 divided by 10 is 60%, 4.6. So whatever my fixed costs are, again, down here at the bottom, everything's the opposite. Whatever my fixed costs are, divided by, those are fixed cost dollars, divided by 0.6 tells you what my break even is in sales dollars. And the same, again, if you're trying to do a target profit, what's the break even in sales dollars? Just add that into your fixed cost divided by 0.6. So if my fixed costs are $100,000, what's $100,000 divided by 0.6? I should be able to do that. I'm going to count it. Your mind goes blank when you're on the computer. $100,000 divided by 0.6, $166,667. That's what my break even in sales dollars are. All right, so that's kind of a brief overview for this chapter. So let's go ahead and look at the exercises here. Let me see if I can share that screen. Chapter 20. This is really kind of a fun chapter. I know you probably find that hard to believe. I'll make sure I'm sharing the right thing here. All right. So what we have here in the pre-lecture is several really straightforward questions about what I just had my short lecture on. Frank's funky sound, straight line depreciation on trucks is fixed, right? Depreciation, that doesn't vary, usually doesn't vary based on your volume of sales or volume of production. Unless you got units of production depreciation, but nobody does. Straight line, as it says here, right? It's going to be the same whether you sell or make 100,000 units or 1,000,000 units. So that's fixed. You know, they use another term there talking about mixed cost. Mixed cost is just a combination of fixed and variable, kind of like what I talked about with the cell phone plan, the old cell phone plans, and also the electricity invoices at Exide would be mixed. More on that later. All right, so the first question here is If an agency is charging $14,000 per month, flat fee, that means it's fixed, plus $2 per passenger service, what's the total reservation cost of 150,000 passengers take the trip? So it's going to be 150,000 times $2 plus the 14. It's 314,000. All right. Number 3, if the total fixed cost 50,000 per month, the variable cost per passenger is 10, and ticket sale for 50, what is the contribution margin per unit and contribution margin ratio? So again, going back to that formula I just showed you, $50 is my sales price minus $10 is my variable cost, right? That gives me $40 contribution margin per unit. Again, that goes back to this sheet of paper I just showed you, right? And that $40 divided by 50, right? My contribution margin divided by my sales price is 0.8, 80%, or 0.8 is what you would plug in if you're doing the formula to calculate this, as we will here later. All right, number 4. Fixed costs are 40,000 per month. The variable cost per passenger is 10. Ticket sale for 50. What's the break-even point in units? Again, 50 minus 10 is $40, right? $40. And $40,000 divided by 40 is 1,000 passengers. So, and you can work that out. 1,000 passengers times what? $50 is $50,000 total revenue. And the variable cost is 10. So $50,000 minus $10,000 is what? $40,000 contribution margin minus $40,000. See how that works? All right. Number 5. Cost, volume, profit graph. That's something you'll have to read your PowerPoint on. But what it's got there is the total cost line intersects the vertical dollars axis at what? The level of fixed cost. I'm not going to bother writing that. That's pretty straightforward since there's actually good charts in your PowerPoint. So go back and look at that if you're not sure what that's trying to say. Number 6. If a company increases its sales price per unit, the new break-even point will what? Decrease, right? If your sales price goes up, your variable costs stay the same, then your contribution margin per unit goes up, doesn't it? And so if that goes up, then you're going to have a lower break-even point. Number 7, if the company increases its fixed cost for product B, then the contribution margin per unit will what? Nothing changes. Contribution margin is sales price minus your variable cost per unit or in total. All right, and finally here in the pre-lecture, got a data table here of average revenue, or these are the revenues for the past 5 years. They're trying to predict 2018. And the break even is 525. What's the predicted margin of safety? So we're going to average those 5. Excuse me. Average those 5 divided by 5. That says $800,000 is expected revenue based on the average for the past 5 years. And so if my break even revenue is 525, then my margin of safety is what? 275. That particular analysis is not used that much in business, but there it is. I mean, how relevant is averaging your last 5 years revenue? I mean, it's what happened 5 years ago relevant for now. All right, so let's look at practice set 1. Let me see if I'm sharing this. I believe I am. All right, here we've got total fixed costs for the month is $40,000. Variable cost per passenger is $40. Ticket sale for 50. So 50 minus 40 is what? $10 contribution margin. And the contribution margin ratio is 10 divided by my revenues, 20% or 0.2. So if my fixed costs are $40,000 and I want $170,000 in operating income, I need to add those two together. Remember when I said that formula for break even is the same as when you're adding in a targeted profit That's my targeted profit, earning 170,000. So I add those two together on the top line. It's just like adding additional fixed costs divided by 20% or 0.2. It says my revenue needs to be $1,050,000 to break even. So there's an example of using contribution margin ratio. All right, number 2. Philadelphia Acoustics builds innovative speakers, and they want you to designate whether it's fixed, variable, or mixed, meaning mixed is a combination of both, variable and fixed. Units of production depreciation, now that is variable, right? Not straight line. If this had been straight line depreciation, it would be fixed. But since it's units of production, meaning however many units I produce, I'm going to have that much depreciation per unit is variable. The wood is variable because that's direct material. Usually your direct material and your direct labor are variable, 100%. It's your overhead, it's a mixture. Overhead is a mixture of fixed and variable. What about patents? Well, that's similar to fixed assets or property, plant, and equipment. That's going to be fixed. Total compensation, the salesperson receives a salary plus a commission. That's mixed. Salary plus commission. Crossover relays, again, that's direct material. Straight line depreciation, fixed. Grill cloth, again, that's direct material. Insurance on corporate office, fixed. That doesn't vary based on your sales. The glue that you use, that's an indirect material probably, but it's variable. It varies with your production. And your quality inspector salary. We just looked at chapter 19, didn't we? Inspection, appraisal, it's going to be fixed. Unless they're working overtime, usually the overtime, the salary is fixed, but the overtime is going to be variable. But that's fixed. They don't say anything about overtime. All right, number 3. We got a company sells a product for $75 per unit. Variable costs are $65. Fixed costs are $800. So very clear there, the contribution margin per unit. Expect to sell 590 units. All right, so 590 times $75 should be $44,250 minus $65 per unit times 590 gives me a variable. So there's my contribution margin in total. Again, that's total. That's not per unit. That's total contribution margin. It's like the example I gave you here earlier, right? That's an income statement format. So there's my contribution margin. Contribution margin ratio is just contribution margin divided by sales revenue. Number 4, company sells a product for $80 per unit. Variable costs are $60 per unit. Fixed costs are $500 per month. Company expects to sell 570 units, so there's my 570 times 80 is 45,600, 570. Hope that's sharing. 570 times 60 is going to be 34,200, 11,004. Operating income. Oh, there. Now it lets me highlight. I was worried about that. Okay. Number 5. Right here we got 3 different companies. Sales price, variable cost, total fixed costs, targeted profit. Right there it is, target profit. TP, as I had in my handout there at the beginning. So sales price minus variable, 280 minus 70 is 210. And that 210 divided by 280 is 75% or 0.75. Used to break even. It's going to be what? Sales price 280 times $79,590 divided by 210 gives me 379. Of course, 379 times what? My sales price will give me required sales dollars to break even. Or you can do the ratio. You can take total fixed costs divided by what? 0.75 will give me 106,120 as well. 2 ways to do the same thing. And then required units to achieve target profit. All I'm going to do is just add that target profit in to my total fixed cost. in order to get the answer. Let you see that there if you want to maybe look at that, but very straightforward, good problem there. Number 6, it's kind of a fill in the blank based on information that's given. Here's the calculations. Some of these you have to kind of work in reverse order. Its contribution margin is $9.90 and sales price is $22. Then that says that's going to be $12.10, right? All right. This one, if it's 50% and your variable costs are $2,600, then that has to be double 2,600 times 2, right? If that's 52 and that's 2,600, then that's got to be 2,600. All right. 2,600 minus 2,080 gives you 520. And that gives you your contribution margin ratio. And so based on required units to break even, it's going to drive your 234,000 fixed cost. All right, that's a pure math problem. Number 7. Good exercise. This is one that's called the high-low method. Had to think a minute. The high-low method of calculating your fixed and variable. Because what if you have a mixed cost? Right? What if you know the total cost and the volumes, but you don't know what portion is fixed and what portion is variable? It's good exercise. And so what you're doing, you're taking the change in total cost, right? The change, which is what? $4,500 up there at the top. Won't let me highlight that. 4,500 minus 4,100. So the overall change in cost is $400, isn't it? My range. Well, I'm going to compare that or contrast that with my changes in number of inspections. So for 800 inspections, if it costs 4,100, and for 1,000 inspections, 4,500, then I've got what, 200 inspections that change $400. That says the variable cost per inspection must be $2. So then the question is, what part is fixed? Well, pick one of those costs, like 4,500 minus the total variable cost, 2 times 1,000. So 4,500 minus 2,000 says my fixed cost must be 2,500. This is what's called the high-low method. Very important. It's a good way to figure out what your fixed and variable split is. When we get to the chapter on budgeting, flex budgeting, it's the last chapter, chapter 23. Very important that you understand this fixed variable split. Very important. You'll see that when we get to that very last chapter. All right, so then they want you to write the equation and calculate the operating cost for 900 inspections. So $2 variable times 900 plus 2,500 says the total mixed cost is 4,300. And then they want you actually to plot this on the line. And so this is what I was referring to a minute ago in that question when it asked about what happens when the total cost line intersects the x-axis. That's the level of fixed cost. See, 2,500, that's my fixed cost. You know that on one page. There we go. And so when you plot these three here in my accounting lab, you're going to plot these three different 800, 900, and 1,000 total cost. It's a straight line, isn't it? Yes. Yes, it is. There it is. See how you plot that out there? But there's the break even. Or excuse me, not break even. There's my total fixed. So if I don't have any inspections, I'm going to have $2,500 in cost to cover. You know, these companies that start up, they're small businesses. Maybe it's a Subway or maybe some little coffee shop in downtown Johnson City. They should be calculating how much am I going to have to spend before I break even? What's my lease? How much is my lease? What's my electricity? Probably labor is a fixed cost, because you're going to have people working there whether you got a lot of customers or not. Now, sure, if your business is slow and you send people home, that's a different part of the equation. But how much do I have to cover before I break even? And then that's when you look at what you're selling a cup of coffee for versus how much material goes into that cup of coffee. How many cups of coffee do I have to sell to break even? Or how many Subway sandwiches and, of course, chips and drinks and all that? It gets a little more complicated when you talk about all the various things they can sell. But you have to consider, what fixed cost do I have to cover? That's why this is a very real chapter in you as a business person, not just for accountants. In fact, accountants usually aren't the ones using this type of stuff in their job. They're all concerned about doing the external. And finally, number 8, get another break-even analysis, number of units, sales price, variable costs. I think you know by now how to calculate that with those instructions that I've given you. All right, so that's practice set 1. Look at practice set 2. Yeah, let me make sure I'm sharing this. So here they're trying to figure out sort of what they call sensitivity analysis. If you read through the PowerPoint, you'll see that term used, sensitivity analysis. It's really a what if scenario. What if I do this? What if I raise the price of a ticket? What if I'm able to lower my cost, whether it's variable cost or fixed cost? How does that impact my break even? What if my target profit is this instead of that? All right, so that's what we're doing here from this practice set 2. But really, if you understand practice set 1, this shouldn't be any more difficult. It says they sell tickets for $100 a person, 1 day entry. Variable costs are $60, fixed costs are $254,000. Break-even point is $63.50, and break-even point sales dollars. So they give you all that information. Now the question is, what if they cut the ticket price from $100 to $80, right? So now 80 minus $60 is 20, isn't it? See? So now my required sales units has gone up from 6,350 all the way up to 12,700. Right, that's a big jump. I don't have to sell a lot more if I lower the ticket prices. And then what would that be in sales dollars? Well, the same numerator divided by 0.25, right? 20 divided by 80 is 0.25. Or you can do what? Take 12,700 times $80 gives me this, right? 2 different ways to do the same thing. 12,007 times $80 is 1,016,000. Okay, now ignore the information from requirement 1. Well, if you increase the variable cost from $60 to $75, what's the new break even? All right, so what would that look like? Requirement 2. $80 per ticket minus 60 is 20. $10,160 tickets. And then required sales dollars, 1,016,000. All right, number 2. In this what if scenario, imagine time park sales tickets $100 per person as a 1-day entrance fee. Variable costs are $20. There it is, 544,800 divided by 80. See, I love how they use these formulas here. Target profit, they put in the same formula as fixed cost, because that's what a target profit is. You're just, what cost do you have to cover to reach your objective? All right, required sales in dollars, 681, or you can take 6,810 units times the sales price, all right, which is what, $100 to get 681,000, or you can divide your fixed cost by 0.8 to get that. All right, number 3. Fun day sales tickets at $60. Variable cost 24, fixed cost 226,800. Break even number of tickets is 6,300. They expect to sell 6475. So 6475 minus my break even, that's my margin of safety. That's what I expect to sell based on my budget. And we've already calculated, that's given what the break even is. You can do that yourself if you want to. The information's there. And what is that in dollars? Well, 175 times my sales price. Margin of safety. Finally, number 4. All right, costs that do not change in total over wide ranges of volume. Fixed costs. How do those numbers not line up? Okay, so 2 is technique that estimates profit or loss results when conditions change. What's the technique? Sensitivity analysis. What if? Plant the sales level at which operating income is 0. Sounds like break even, doesn't it? Drop in sales, a company can absorb without incurring an operating loss. Margin of safety. Combination of products that make up total sales, that's your sales mix. Net sales minus variable costs, that's contribution margin. Describe how a cost changes as volume changes. Behavior. It's fixed and variable. Costs that change in direct proportion to changes in volume, that's variable. And this last one is a good term, relevant range. The band of volume where total fixed costs and variable costs remain constant. That's your relevant range. It's very important. That relevant range might be if you've got a company making anywhere from 9 million to 10 million units would be the relevant range. But if you get beyond 10 million units, your fixed costs may go up because you may have to add brick and mortar, you may have to add another shift, more salaried supervisors, more property, plant, equipment, which means more depreciation. But the relevant range, that's what we're assuming in this chapter. This chapter is about the relevant range. Fixed costs stay the same, variable cost per unit stays the same. Very important, relevant range. All right, and then finally, we're going to look at the self-assessment here. Again, let me make sure I'm sharing this. It looks like I am. All right, this is sort of another analysis where you got to fill in the blank. I don't think I need to go through this. You can do this on your own. You see the answers there, the actual information is given there. Fill in the blank. Sort of like working a puzzle. As long as you got those formulas, should be fine. Which company has the lowest break-even point in sales dollars? All right, again, the 4 companies, sunny, rainy, cloudy, and windy. Obviously, sunny requires sales in dollars. So windy has the lowest, right? Because it's low fixed cost, divided by 50%, very low, right? Good exercise. All right, so that is chapter 20. We don't cover chapter 21 in this Accounting 2020. So that leaves chapter 22 and chapter 23. And you're going to find chapter 22 is very short. So I will probably group chapter 22 with 23 because they are both about budgeting. But chapter 22 is very short. And that's because I spent a lot of time on chapter 23 with flex budgets, flexing based on variable cost and flexing based on revenue, because revenue and variable costs are 100% flex. Very important chapter. You as a manager, future leader in your companies need to understand. So we'll talk again soon.